Hi, I am Anna. I come from www.ntvforex.com. U.S. payrolls, services PMIs, RBA, restaurant group, Barratt developments, and Zoom analysis. http ntvforex.com news ID 235C888282020 11:49:41 a.m. 1 U.S. non-farm payrolls A0409A. The recovery in the U.S. labor market that we saw from the July payrolls report turned out to be slightly more robust than expected, with 1.76 million jobs added, despite concerns over rising infection rates prompting delays to reopening in a number of U.S. states. What was particularly notable in July was the number of jobs that came back in services like retail and restaurants, sectors that had been hit the hardest by the pandemic. As we look ahead to this week's August report, we need to pay attention to the underemployment rate, as well as the unemployment rate, given that a lot of U.S. workers may well have seen their hours cut back. So far, we've seen a total of 9.2 million jobs return since the loss of a record 20.7 million jobs in April, which means we still have some way to go before the U.S. economy is anywhere near close to a sustainable rebound in economic activity. This week's August payrolls report will also be important in the context of how it reflects the 2 weeks at the end of July where we saw a host of U.S. states reimpose lockdown measures, and which, at the time, saw the latest weekly jobless claims numbers start to edge back up again. Expectations are for another 1.7 million jobs to be added, pushing the number of jobs clawed back since April up over 10 million, still less than half of those that have been lost since March. 2 Global Services PMIs AUG A0309A. The recovery in services sector activity in August could well have ground to a halt in Europe if the recent flash PMIs for Germany and France are any guide. This is a big concern, particularly for the weaker countries like Italy and Spain who rely so much on tourism in the summer months. The imposition of quarantines and other travel restrictions in August is likely to see the recent recoveries in those economies in July grind to a halt in August. It hasn't been all bad news, as we've seen the UK and US services numbers continue to improve, while Chinese services activity has also held up fairly well. The fear now is that with the European recovery stalling and the quarantines being imposed on travelers across Europe is that the European recovery grinds to a halt, at a time when it appeared to be finally gaining traction. The various restrictions being imposed in Spain, as well as Italy, are likely to see similar sharp slowdowns, back into contraction territory, after the sharp drops in the flash PMIs in Germany and France. In the UK there appears to be slightly more optimism, though the UK recovery is slightly behind Europe's. The UK showed a continuation of the improvements from July, and is expected to come in at 60.1, while France and Germany are expected to slow to 51.9 and 50.8 respectively. Spain and Italy's July readings came in at 51.9 and 51.6 respectively, however they could well struggle to even get close to these in this week's August numbers. 3 RBA rate decision A0109A. With Australian interest rates already at record lows of 0.25%, there had been speculation that we could see more QE from the RBA, in the event the economic picture was to deteriorate further. Aside from the lockdowns and rising infection rates across the state of Victoria, the overall picture in Australia hasn't been that bad, despite some evidence of a slowdown in the services sector in July. The impact of this was reflected in a slight rise in the unemployment rate, which is already at its highest level since 1999, at 7.5%, and is expected to move up to 9.25% by year-end. Despite this rise in unemployment, there has been little indications so far that the RBA appears inclined to do any more than it already has done in terms of supporting the economy, while the lockdowns across the state of Victoria of Melbourne appear to have had little impact on slowing the recent spread of the virus. This may change in the coming days given the recent rise in the Australian dollar, which is over 20% off its lows set earlier this year in March, as it gets dragged higher by a weaker US dollar. 4 U.S. weekly jobless claims A0309A. Concerns over a rise in weekly jobless claims in the wake of the ending of the $600 a week enhanced unemployment benefits package, at the end of July appear to be starting to be realized, after the sharp rise in weekly claims that happened a couple of weeks ago when we saw a sharp 130K rise in claims. which pushed the number back over the symbolic 1M mark to 1.1M, from 963K. While last week saw a stabilization at around 1M claims, the feeling is that in the absence of new fiscal stimulus measures from US politicians, we'll start to see this number head back higher again, in the weeks ahead. If this were to happen, it could well concentrate minds on Capitol Hill, who appear to have become complacent to the risks facing the US labor market, in the face of new record highs for stock markets, as these same out-of-touch politicians go into full-on campaign mode. 5 U.S. Beige Book A0209A. The most recent Fed minutes showed that Fed members continue to have concerns about the overall direction of the U.S. economy, particularly over impacts on the labor market. The last Fed Beige Book indicated that while economic activity was improving in July, there was a mixed picture as far as employment was concerned, with talk amongst companies about job losses, particularly with respect to weak demand in the services sector. There were also anecdotal reports of wage cuts and pay freezes, across a variety of sectors, from manufacturing to agriculture to film and television, with a lot of temporary layoffs in these sectors likely to become permanent. This week's Beige Book could well see this trend continue in the wake of a virus rate that could well keep economic activity subdued, and the U.S. economy at well below its pre-pandemic capacity for quite some time to come. 6 Barratt Developments FI 20A0209A. When Barratt released its pre-close trading update in July, the company painted a fairly positive picture for its full-year numbers, despite the shutdowns in April and May. All sites were reopened by June 30, while completions were down for the full year from 17,856 in 2019 to 12,604 this year, largely down to the shutdown in the final quarter of the year. The full-year order book has remained strong, with forward sales well ahead of last year's 11,419 at 14,326, with a value of a 3.25 bn. Overall selling prices were more or less in line with last year's levels, with the total selling price at a 280k, only slightly above 2019's a 274.4k. The company also thanked the government for the support offered to the sector, with respect to the job retention scheme, and said it will repay all furlough money used during the shutdown to pay its employees. 7 Restaurant Group H120A0309A. In June, Restaurant Group announced the closure of 125 sites as it attempted to restructure its business in the face of the challenges being wrought on it by the shutdowns caused by coronavirus. Most of the shutdowns will affect its Frankie and Benny franchises, while its Wagamama brand has escaped more or less unscathed. These closures will mean that the company will be left with 160 restaurants, with the hope that further closures can be avoided, with a reduction in rents and other costs. Restaurant Group's biggest problem has been that a lot of its restaurants have been in areas like cinemas, as well as retail parks, where footfall has struggled to recover, notwithstanding the reluctance of consumers to go back to the cinema, where social distancing is proving difficult. The hope is that the Chancellor of the Exchequer's Eat Out to Help Out in August has provided the remainder of the business with a timely lift at a time when the whole sector has been struggling to reopen. Anecdotal evidence suggests it has, with big queues outside Wagamama restaurants between Monday and Wednesday. S8 Zoom Video Communications AQ221A3108A. While a lot of companies have suffered a great deal from the coronavirus pandemic, Zoom hasn't been one of them. The economic lockdowns have been a boon to this young upstart company, which only came to market just over a year ago at $36 a share with a valuation of $9 bn. The biggest concern at the time was the technology was easily replicable, but unlike a lot of its IPO peers at the time, was able to turn a profit, which automatically set it apart as a company worth watching. There was also the fact that a lot of its competition in the form of WebEx, Logmain, and Skype were pretty mediocre, and had products which weren't really core offerings. Last year revenues rose to $622.7 million, pushing the market cap up to an eye-wateringly high $44.3 bn, as the share price rose above $180. In its most recent quarter, the company saw revenues rise to $328 million, with a prediction that revenues this year could rise to $1.8 bn, almost double its previous estimate. Unsurprisingly, investor enthusiasm for the company has risen exponentially, sending the shares up to within touching distance of $300, a far cry from where it was at the turn of the year, a rise of over 300%, and a market cap of over $80 billion. In light of these gains and the current valuation, there is a sense that while Zoom has done very well this year, questions do need to be asked as to whether the company is worth over $80 billion. For a start, Zoom's success has prompted its competitors to up their game, so the fledgling company could find life. It has to work that much harder to stand still as time goes by. This could well put the current valuation under slightly more scrutiny, amongst questions as to whether it's sustainable at current levels. Q2 profits are expected to come in at $0.45 a share. 9 Brown-Forman A Q1 21A0209A. The Brown-Forman share price has recovered fairly well from the declines seen in the March sell-off, reaching new record highs earlier this month. At the end of last year, the company saw net sales come in flat on an underlying basis at $3.4 billion, while operating income fell 5% to $1.1 billion. Its U.S. market saw the best performance with a net sales rise of 5%, while international and emerging markets acted as a drag, probably as a result of the various increases in tariffs, particularly in the context of EU-US trade relations. The company did pull its guidance, but said it still expected to be able to pay regular dividends despite the uncertainty around COVID. In July, the company paid a quarterly cash dividend of $0.1743 a share, and said it expects to be able to continue to do so, keeping intact a record of payouts dating back 75 years. Q1 profits are expected to come in at $0.30 a share. 10 DocuSign Q2 21A0309A. Another tech outperformer that has seen its shares rise exponentially since the beginning of the year, up over 170%. The electronic signatures company has seen revenues rise sharply this year as new clients use this new technology to close contracts remotely. In Q1, the company saw revenue rise by 39% to $297 million. In Q2, the company said it expects revenues to grow further, to $318 million at its midpoint, while losses were steady at $0.46 a share. Since its Q1 numbers came out, the shares have continued their rise, hitting new record highs at the beginning of August. The big question, as with all of these unicorns, is whether the company will be able to turn a profit, while also justifying a $39 billion valuation on annual revenues of just over $1 billion. The company is expected to turn a quarterly profit of $0.08 a share, in what it hopes will be the first year the business turns a profit. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.